rules that can be applied. First of all, when we are trading in line with the higher time frame order flow, we can anticipate the full market maker model to complete. Meaning, if we have a bullish higher time frame bias, we can anticipate the market to draw towards the original consolidation, its respective high. This completes the market maker buy model. If we, however, are targeting a level that is above the original consolidation, its respective high, as our higher time frame draw liquidity, we can not only take a big partial at the market maker buy model's completion, but we can also leave a runner to draw towards that higher time frame draw liquidity. That runner then turns your short-term trade into a long-term trade. And if your draw liquidity is correct, that runner can cause your equity to grow tremendously. Now, if you're trading against the higher time frame order flow, or when there's no higher time frame order flow clear to you, what I would suggest you to investigate how many times the market tries to gravitate towards 50% of the range between the original consolidation and the smart money reversal. If you have, for example, a bearish idea in mind, in which you are looking for a short setup, instead of targeting the original consolidation, its respective low within the market maker sell model, I would suggest you to investigate how the market will react to 50% of the range from the low of the original consolidation to the high of the smart money reversal. If the higher time frame order flow is not clear, it's never a bad idea to take a partial right here. Especially when you're a newer student, I would suggest you to be content with partials along 50% of the market maker model. You slowly gravitate towards full pulls in which you have the strong liquidity of the original consolidation and you anticipate it to get reached. That takes time, and allow yourself to grow into that. We're now going to discuss how you can maximize your profits whilst keeping your risk equal or actually decreasing it. Let me explain. We're going to do this by pyramiding. Before we dive into pyramiding, I must say that the people that are completely new to trading and are completely new to trading ICT concepts should not look to pyramid, because pyramiding can be dangerous if you do not know how to do it properly. Therefore, until you have a clear understanding of order flow and until you're able to clearly recognize market maker models, I would suggest you to not look to pyramid. However, if you're at the stage where you're able to see all of the opportunities to get in within market maker models, please begin looking into this. Pyramiding is the process of increasing our position size behind a trade. Please note that we only look to pyramid into winning trades. We never look to pyramid into a losing position. When we have an entry established inside of the low risk phase and we see the market displace away from our entry and a new bullish for value gap gets created, we can look for that bullish for value gap to function as support on price. I already outlined that this bullish for value gap has to function as support on price. When you understand this, you are able to understand that you're allowed to throw your stop loss to the low in which you entered. And here comes something interesting. When you throw your stop loss to your entry price or in close proximity to it, it means that you're decreasing risk significantly. However, if you want to keep the risk equal for the whole position, what you're then allowed to do is you're allowed to pyramid inside of that bullish for value gap, because you're anticipating that it will function as support on price. What this looks like is the following. If you go long 3 contracts initially, you're allowed to go long 2 contracts in the next entry opportunity. This means that your average entry price will increase, but you will also be able to increase your stop price, and therefore your risk will remain relatively equal. The moment that price does expand in your favor, you'll be able to have a tremendous win because you have kept the risk equal, but you have increased the position size, and therefore you have increased the profit potential behind that position. Let's take a look at pyramiding from a bearish example now. If we are anticipating lower prices for this market and we see the market run up higher into a higher time frame key level at the right time, and we see the signatures that we're looking for in order to confirm a high formation, followed by displacement lower, we can look to go short inside of the retracement into the bearish value gap, which will get created. If we go short inside of this bearish value gap with 3 contracts, with a stop being above the swing high, and the market displaces away from that fair value gap, creating a new bearish fair value gap, we can look for that bearish fair value gap to function as resistance on price. Remember how I explained to you how we can throw our stop losses. When we understand that this bearish fair value gap should function as resistance on price if order flow is in fact bearish, we can look for our initial stop price to be lowered tremendously. If we are able to trail our stop loss then to that previous high in which we entered, we are able to remove risk from this position initially. But if we decide to want to keep risk inside of this position because we anticipate our analysis to be correct, we can look to pyramid inside of this bearish value gap, and our stop loss for this pyramid entry will be above that previous high. That is an intermediate term high. That high should not get displaced above if order flow is bearish. This allows us to go short with 2 more contracts, making the total position size 5 contracts short now. If the market then expands away from this second entry, we know that our stop loss is at a safe place and we could even trail it even more because the market should now deliver towards the market maker sell model, its original consolidation. The moment that price trades below the original consolidation, the market maker sell model is completed. Now, what I need you to understand is the following. Notice that within these examples that I've provided to you, we decreased the amount of contracts that we were adding inside of the pyramid opportunities. We did not go from 1 contract as our initial entry to 2 contracts as our pyramid entry. No, we went from 3 contracts as our initial entry to 2 contracts as our pyramid entry. We never pyramid from the bottom to the top. We always pyramid from the top to the bottom, meaning our biggest entry comes first, always, because if you don't and the market runs against you, you will see that the damage will be increased significantly. But if you pyramid from the top to the bottom, where you have your biggest position initially on, and you pyramid onto that position, always with smaller positions, whilst you're managing your risk accordingly by trailing your stop losses, you will see that you will be able to manage your positions accordingly whilst keeping risk relatively equal. And that is the goal, to keep the risk relatively equal as long as the analysis that you have created is playing out. If the market then delivers towards your final target, the profit behind the position will be increased tremendously relative to, for example, only having 1 entry in. Remember, if you're completely new to trading, this is an advanced method of entering. So therefore, stick to 1 entry. But if you're more advanced already and you have more experience, you can look into pyramiding on demo accounts at first.